Your government doesn't control your money. A private bank does. That private bank was created by other private banks, is owned by private banks, and exists primarily to serve private banks. But it operates with government authority, government backing, and government legitimacy. It can create money, set interest rates, and determine economic policy with less democratic oversight than a city council. Most people call this arrangement central banking. Economists call it independence. History calls it the most elegant power transfer ever achieved without revolution. Welcome to the financial historian, where money, power, and history collide, and nothing is ever as simple as it looks. When people imagine central banks, they picture government institutions serving the public interest, wise technocrats managing the economy, protecting consumers from inflation, maintaining financial stability for everyone. The language supports this illusion. The Fed serves the American people, monetary policy for the common good, economic stability and growth. But this framing conceals a more complex reality. Central banks were not created by governments to serve the public. They were created by private banks to serve themselves, using government authority as cover and government resources as backup. To understand how this happened, you need to understand the problem central banking was designed to solve. And it wasn't inflation, unemployment, or economic growth. It was bank liquidity crises. Before central banks, individual banks failed regularly. When depositors lost confidence, they demanded their money back simultaneously. Banks, which lent out most deposits, couldn't meet sudden withdrawal demands. Panic spread from bank to bank. The entire system could collapse within days. This created a problem for successful bankers. Bank failures wiped out individual institutions, but they also threatened the banking system's credibility. Every failure made depositors more nervous about all banks. Every panic made credit more expensive. Banking was profitable during calm periods, but catastrophically risky during crises. The industry needed a solution that could provide emergency liquidity without appearing to be self-serving. The breakthrough was institutional rather than technical. Instead of each bank maintaining its own reserves, banks would pool resources in a central institution that could lend to any member bank facing liquidity pressure. This institution would be large enough to calm panics, sophisticated enough to distinguish between temporary illiquidity and fundamental insolvency, and credible enough to reassure depositors that their money was safe. But there was a political problem. If banks created this institution themselves, it would look like a cartel designed to protect bank profits at public expense. If government created it, politicians might use it to serve political rather than banking interests. The solution was brilliant. Create a hybrid institution that appeared governmental but remained banker-controlled. Give it public authority but private ownership. Make it appear to serve the public while ensuring it served the banks that created it. This is how the first central banks were born. Not as government agencies, but as private corporations chartered by government and granted extraordinary privileges. They could issue currency, set monetary policy, and act as lenders of last resort. But they were owned by commercial banks, governed by banker-selected boards, and operated according to banking rather than political logic. The Federal Reserve, created in 1913, perfected this model. It was structured as a hybrid institution: private ownership, public authority, banker governance, government backing. The 12 regional Federal Reserve banks are private corporations owned by local commercial banks. These banks elect most of the directors who govern regional Fed operations. The Board of Governors in Washington provides coordination and public oversight, but regional banks retain substantial autonomy and banker influence. This structure was not accidental. It was the result of careful negotiation between banking interests and political forces. Banks wanted control but needed legitimacy. Politicians wanted oversight but lacked technical expertise. The compromise gave banks operational control while providing politicians with appointment authority and public accountability mechanisms. Everyone got something, but banks got more. The genius of this arrangement is how it obscures the power relationships involved. The Federal Reserve appears to be a government institution serving the public interest. Fed officials testify before Congress, follow government procedures, and speak in terms of national economic policy. But the institution's actual structure, ownership, and governance ensure that banker interests receive priority consideration even when they conflict with public interests. Consider how this works in practice. When banks face liquidity crises, the Fed provides emergency loans at favorable rates with minimal questions asked. When consumers face credit crunches, they're told that monetary policy must remain independent and market-oriented. When bank profits decline, interest rates get cut quickly. When wages rise too fast, interest rates get raised to cool the economy. The system responds rapidly to banker concerns and slowly to public ones. This asymmetry isn't conspiracy, it's design. Central banks were created to solve banker problems, and they solve them efficiently. Public benefits are secondary effects that justify the system's existence, but don't determine its priorities. The Fed serves the public interest when banker interests and public interests align. When they conflict, banker interests typically prevail. The 2008 financial crisis revealed this priority structure clearly. When major banks faced insolvency, the Fed provided trillions in emergency loans, purchased toxic assets, and guaranteed bank operations. When homeowners faced foreclosure, they received modest assistance programs with strict eligibility requirements. When unemployment surged, monetary policy eventually responded, but financial sector stabilization came first. This wasn't favoritism, it was the system working as designed. Central banks exist primarily to maintain financial system stability, which means keeping banks operational. Everything else is secondary. The Fed can't allow major banks to fail because that would undermine the system it was created to protect. It can allow homeowners to fail because individual mortgage defaults, while personally tragic, don't threaten systemic stability. But the most important aspect of central banking isn't crisis response. It's everyday power. Central banks control the money supply, which determines credit availability, interest rates, and asset prices. These decisions affect every economic relationship in society: who can borrow money, how much houses cost, whether businesses expand, how much savings earn. Central bankers make these decisions with minimal democratic input and maximum banker consultation. The Federal Reserve meets regularly with bank executives, receives detailed bank input on policy decisions, and considers banking industry concerns as primary data for monetary policy formation. Public input is limited to formal comment periods and congressional hearings that occur after decisions are made. The consultation process is structured to prioritize banker expertise over democratic participation. This creates a feedback loop where monetary policy serves financial sector interests that may conflict with broader economic interests. When the Fed keeps interest rates low to stimulate economic growth, it also inflates asset prices that benefit existing asset owners while making homes and investments more expensive for everyone else. When it raises rates to control inflation, it increases unemployment and reduces wage growth while protecting the purchasing power of people with savings. Each decision involves trade-offs between different groups, but central bank governance structures ensure that financial sector perspectives receive more consideration than other viewpoints. Bank executives have regular access, technical expertise, and professional relationships with central bank officials. Workers, consumers, and small businesses have periodic testimony opportunities and distant representation through political processes. The result is monetary policy that appears technical and neutral, but systematically favors financial sector interests. This isn't corruption, it's institutional design. Central banks were created by bankers to solve banking problems, and they continue to operate according to that original purpose, even as their public responsibilities have expanded. Modern central banks also possess extraordinary emergency powers that can reshape entire economies with minimal oversight. During crises, they can purchase unlimited quantities of government bonds, corporate debt, and even stocks. They can lend to any institution they choose at any terms they determine. They can create money without congressional appropriation or judicial review. These powers are justified as necessary for crisis management, but they give unelected officials more economic influence than most elected politicians. The Federal Reserve's response to the 2020 pandemic illustrated this power. Within weeks, the Fed announced trillions in new lending programs, purchased corporate bonds for the first time in its history, and committed to unlimited government bond purchases. These decisions were made by Fed officials without congressional approval, public debate, or democratic accountability. They were technically legal and probably necessary, but they demonstrated how much economic power has been transferred from elected governments to banker-controlled institutions. This power transfer accelerated during each financial crisis. Every emergency expanded central bank authority, and that authority was never fully rescinded afterward. Emergency measures became permanent capabilities. Crisis responses became normal operations. Exception became routine. Central banks accumulated powers that would have been unthinkable when they were created, and they did so while maintaining the appearance of public service and democratic legitimacy. The European Central Bank provides an even clearer example of banker power operating through governmental structures. The ECB is owned by European national central banks, which are themselves owned by commercial banks. It operates with less democratic oversight than the Federal Reserve and more explicit independence from political influence. During the European debt crisis, the ECB essentially dictated fiscal policy to elected governments by threatening to withdraw monetary support unless they implemented banker-preferred austerity measures. This wasn't economic technocracy. It was financial sector political power operating through institutional mechanisms that appeared non-political. The ECB used its monetary authority to override democratic decisions about taxation, spending, and social policy. Elected officials were forced to choose between implementing policies their voters opposed and risking financial collapse. Most chose compliance over democracy. These examples illustrate central banking's fundamental political reality. Institutions created to solve banker problems inevitably serve banker interests, even when they acquire broader public responsibilities. Democratic accountability mechanisms are weak compared to institutional structures that prioritize financial sector input and banker expertise. Public service rhetoric masks private power exercises. Understanding this doesn't require believing in conspiracies or secret cabals. Central banks operate transparently according to their institutional design. The problem is that most people misunderstand what that design actually is. They believe central banks were created to serve the public when they were actually created to serve banks. They assume democratic accountability when the structure ensures banker control. They expect public interest prioritization when the system is designed for financial sector service. The Federal Reserve's own documentation makes this clear. It describes itself as independent within government rather than a government agency. It emphasizes its freedom from political interference rather than its accountability to democratic processes. It highlights its banker governance rather than its public ownership. The institution accurately describes its nature, but public understanding doesn't match institutional reality. This gap between perception and reality matters because it shapes expectations about how central banks will behave during crises. If you expect central banks to serve the public interest equally, you'll be surprised when they prioritize financial sector stability over employment, wage growth, or housing affordability. If you understand that they were designed to serve banker interests first, their crisis responses become predictable. The lesson isn't that central banking is inherently corrupt or that central bankers are personally malicious. Most central bank officials genuinely believe they serve the public interest, and many of their decisions do provide public benefits, but those officials operate within institutional structures designed to prioritize financial sector stability over other considerations. Their good intentions don't override structural realities. Central banks represent a form of power that democratic societies have never effectively addressed: private authority exercising public functions. They combine the legitimacy of government institutions with the interests of private corporations. They operate with democratic approval but without democratic control. They serve public purposes through private mechanisms. This arrangement was probably necessary when it was created. Banking systems needed stability mechanisms that individual banks couldn't provide. Governments lacked the technical expertise and political independence to manage monetary systems effectively. Central banks solved real problems that had no obvious democratic solutions. But institutional solutions create institutional interests, and institutional interests become permanent even when the original problems change. Central banks developed constituencies, accumulated powers, and established relationships that serve their continued expansion, regardless of whether that expansion serves broader public interests. The result is a system where the most important economic decisions are made by institutions that appear governmental but operate according to private logic. Democratic processes influence central bank policy indirectly and slowly. Banking sector interests influence it directly and immediately. And this isn't balanced representation. It's institutional capture dressed up as technical expertise. Modern economies probably require some form of central banking. Complex financial systems need coordination mechanisms that individual institutions cannot provide. But the current system gives private interests extraordinary power over public policy while insulating that power from democratic accountability. That's not technical necessity, that's political choice disguised as economic expertise. The question isn't whether central banks should exist. It's whether institutions wielding such enormous public authority should be owned, governed, and operated primarily for private benefit. Democratic societies have never resolved that tension because they've never acknowledged it exists. Central banking works extraordinarily well for the financial sector. It provides stability, liquidity, and crisis protection. that allows banking to operate at scales and levels of risk that would be impossible without government backing. But that success comes at the cost of transferring enormous power from elected officials to banker-controlled institutions. That transfer was achieved through elegant institutional design rather than political conquest. No revolution was required. No democracy was overthrown. Private interests simply convinced democratic governments to create institutions that serve private interests using public authority. The arrangement benefits everyone enough to maintain political support while benefiting banks more than anyone else. And once established, these institutions become too important to fundamentally reform. They control too much economic activity, employ too many experts, and serve too many necessary functions to be easily replaced. Reform becomes impossible not because the current system works perfectly, but because the alternatives seem worse. This is the ultimate lesson of central bank evolution. Private interests can acquire extraordinary public power through institutional innovation rather than political confrontation. Create institutions that appear to serve the public while actually serving private interests. Staff them with technocrats who genuinely believe they serve the public. Operate them transparently according to written rules that few people read carefully. The power becomes legitimate precisely because it doesn't look like power. That's not conspiracy, that's innovation. And innovation, as always, serves those who design the systems more than those who live within them.